Hello everyone, this is Mark with Semantics Trading with your daily recap. So today we did see a mixed day for the equities markets as there wasn't really any clear pictures in terms of sectors. We're pretty much all over the place. SPX seems to be faltering at a previous key area. In my opinion, risk reward wise, it's not really a bad idea to hedge or go short with appropriate size with risk above 4,200. And as we go into August, historically we do see volatility pick up, and I think as the market has been extended to the upside, it's not a bad idea to put on some VIX longs as seasonality may take effect as well on top of a risk reward type of play. If you take a look at SPX dealer gamma exposure, we are pretty close to flipping into negative gamma, which if we do go into negative gamma, we could have higher volatility as well as dealers selling in response. Also, to put it in perspective, as we go back in history, we can see during the 2000 and 2003 NASDAQ bear markets, we did see double-digit bear market rallies. And if we do not see a significant amount of risk-taking or participation by players, this might just be another bear market rally. It's quite hard to say that the bottom is in, but only time will tell. It also does seem like the Fed is trying to quell fears with choice wording, but they are likely to not surprise the market on the hawkish side in the second half. There is a view that the Fed will pivot sometime soon, but I do not think this will be the case, as the Fed will still be raising rates, mind you, at a lesser rate until at least the end of the year. We do see the euro-dollar futures curve, however, pricing in rate cuts in March 2023, but the Fed denies that will happen until 2024. So there is a bit of a divergence here. And we do see that the real yields did go up a bit today, which is not ideal for risk assets. But mind you, we have dropped quite a bit in the real yields, so a one-day thing is not really as significant in the grand scheme of things, but it is important to monitor this for continuation. And the reason why the yield spiked is because the Fed governors were making comments that were quite hawkish, and they did state that they will continue raising rates until the inflation is under control. The most ideal situation for risk assets and growth is that we see the real yield go deeper into negative territory, which is better for risk stocks as the equity risk premium goes up and the expected return goes up and bonds become a less competitive investment. And if we take a look at the dollar is still holding its trend to the upside, and I do think that we do have more upside potential to the dollar as a global macro environment deteriorates, as foreign players run to the dollar for its high liquidity and safe haven status. And today, we did see the U.S. jobs opening in June fall to a 9-month low, which indicates that labor demand is moderating as economic pressures mount. The jobs market has been a bright spot in the economy, but it is losing steam at the current moment. The demand for workers is going down, but you could say that the demand for workers is not going down, but the froth from inflated listings for openings is going down. And I think when it comes to the Fed, they keep touting this idea of a soft landing, but I do think that the Fed is willing to raise unemployment to 5% in order to deal with the inflation rate and bring it down close to neutral. And so I don't think the Fed will let off just yet, and they may raise rates a bit slower, but I do think they want to deal with inflation for price stability. And with that being said, that is it for today's recap. I want to thank you all for watching. And if you did enjoy the video, be sure to like and subscribe and check us out in the Discord. Thanks again.